welcome back. So in the last session we discussed about the credibility. So let's touch upon the credibility angle. So as I discussed that there are three ways in which central bank can enhance the credibility. One is the approach one, which is about the inflation targeting, that there should be explicit target. As I mentioned that in India also we give a 4 plus minus 2% of target with clear design, and we know that what is the mode of communication, and with proper statement and the resolutions we see the voting pattern and we have all the details available. So this also enhances the credibility. Then here we have whether we appoint a governor who is more hawkish on inflation or who is just indifferent, which is dovish on inflation. If he is hawkish on inflation, normally there is a trend that we appoint a governor who is more hawkish on inflation, so that whenever we see a rising trend in inflation, the governor takes a call and tries to increase the rate of interest. Of course, with regard to the commercial banking, this will have a lot of important implications, and we can find that so whenever we have a rate of interest higher, the cost of borrowing will go up, and then the banks may find it difficult to lend to people because people may postpone if they are high ticket borrowers, right? So the overall mindset or the attitude of the governor matters, and when we hire or when we go for hiring conservative policy maker or RBI governor or the central bank governor, then it is good for the economy that there will be a strong check on rising inflation. But there are for or against arguments. For against argument is that it is good for the economy that you have a watchdog continuously watching on the inflation impulse in the economy. But on the against is that it should not be only inflation criteria, there should be other factors in mind. So we often see that whenever we have the appointment of governors, then this becomes important issue, that whether governor should be growth oriented or only hawkish and dovish on inflation. So approach 2 is important in this regard. In approach 3, we have the institutional independence. What should be the role of RBI, or should the government have the say in monetary policy formulation? In India, we have seen that MPC formation, though we have explicit target and it looks very attractive, but at the same time, we have the people coming from the government side. So, in a pure organic way, we cannot argue that we have 100% central bank independence. But in macroeconomics, there is always a debate on whether central bank should have the complete independence or they should not have been the independence. So this plays very important role in the economy, and this is where it is very important. Approach 1 is the inflation targeting, that how do you target the inflation. So as I mentioned that there should be a explicit target with medium term nominal inflation target. In India we have 4 plus minus 2. There should be a complete commitment coming from the central bank through different statements that they will be always targeting the high inflation scenarios. It may happen that with inflation, the central bank will be also given the jurisdiction of managing the exchange rate, different types of macro variables and global factors. In that case also it becomes important. In India also we had gone for multiple indicator approach, then we moved from multiple indicator approach to single indicator approach, and then so over a period of time we have seen that globally there is shift towards a unified indicator approach, which is the policy rate. In case of India, it is the repo rate. In case of US, it is the federal funds rate and others. The fourth important point is the monetary policy communication and the central bank communication. How good is the central bank communication? In last session, I discussed my own paper, and we found that when Raghuram Rajan was the governor at that time, we had effective communication as compared to Jeet Patel and Sujit Das. So this is where it is important. Accountability for outcomes relative to the target bank, which means that when central bank is targeting 4%, then they should at least be making sure that they are meeting those targets. So that is the accountability criteria, right? And they have to also make it clear that they should have the clear targets, proper communication, so that each and every stakeholder is in sync with the central bank decision. So this is where it is very important. Now coming to the inflation targeting in India, post 2016, We have seen that we adopted the unified or flexible inflation targeting, giving the more weightage to the single indicator, and we created the monetary policy committee, right? In this, so we amended the 1934 RBI Act and created a way for creation of or formation of the monetary policy committee as decision making body, and they have the target, and they always try to come out with recommendations whenever they go for interest rate revision. So it is also important in this regard. In India, there are different indicators which play important role. For example, as I discussed in the last session also, towards in the monetary policy committee resolutions, the communication, the voting pattern, the justification given, all these things play important role. Effect on expectations, which is the household survey, which suggests that inflation expectations have become more forward looking. Market participants track MPC communication more closely. Broader motivation, which is related with the anchors inflation expectations, and also the monetary policy effectiveness, it also plays very important role in this regard. As I was discussing that whether central bank should appoint conservative or the moderately conservative central banker. So Kenneth Rogoff gave this idea that appointing a policymaker with a strong preference for low inflation reduces the temptation to generate short-run booms at the cost of higher future inflation. If the central bank governor is a little indifferent or maybe dovish on inflation, then this may create a short-run adjustment problem. And one good aspect is that if we have clarity that the central bank governor is conservative on inflation, then there will be proper communication to all the stakeholders, that and they will be also satisfied that whenever they find the rate of interest going up, or whenever central bank governor find rate of inflation going up, then they will be keeping a check on the rate of interest also, right? So this is what here we have. But risk is always there, and we saw pre MPC era that there used to be a disagreement between Ministry of Finance and the central bank, because central Ministry of Finance wanted to push investment in the economy, but inflation was not giving that much room. So central bank used to keep the rate of interest high. As a result, the borrowing cost used to go up, and it had an impact on the inflation. But after MPC formation, we see some coordination in this regard. And if you try to to define the current RBI governor, Sanjay Malhotra, then you may find that he is somewhere in middle, not very hawkish, not very dovish. And as of now, what it comes out that he is more of a dovish, because the rate of interest scenarios are more in favor, but at the same time the inflationary scenarios are also favor. So maybe we'll have to give some more time to this governor to understand the exact whether he is completely hawkish, conservative, or moderate. So that we have to see. So in the past, certain interesting cases we have observed. For example, Paul Walker, US Fed from 1979 till 1987, right? He was a bit dovish, so willing to tolerate a depreciation to bring down inflation, right? And Bundesbank, a strong anti-inflation reputation, which we always have during 1980s, 1919. Then Raghuram Rajan, who had the strong emphasis on inflation control, very hawkish kind of, and he also gave the groundwork for the FIT, because government wanted to make a change in this regard. The next important concept is the central bank independence, how we can go about from here. So what is the stand that why central bank independence matter? Because when you are going from, so if the central bank is independent, then it also puts a check on the government, that they know that if they will be having a lot of fiscal leakage in the economy, then the central bank will not keep the interest rate low. So as a result, what they will be putting is that they will be having less borrowing, more fiscal health, and there will not be the political ideology based investment or populist measures. So this also put a check. So independence matters in that regard. That if you have a government working independently, and if the government thinks that the central bank will follow them, then then the government becomes numero uno, and in that case monetary policy may not be that effective, because on the one side the central bank may see a very high inflation because of the over expenditure by the government. But central bank, if it is independent, then it will be always taking a in high interest stand, and as a result there will be impact on the investment and others. But if the central bank is compromised and having no independence, then the government can go and bargain well with the central bank to help them not to increase the rate of interest rate, even though the economy experiences a high inflation, right? So the second is governance, the clear mandates, fixed terms, transparent appointment, and removable rules. So all these things are very important. You should not be having any kind of rent seeking exercise in this. And third is of course about the communication, which is accountability, regular reporting, explanation of deviations from targets, all these things. We find that globally Bundesbank has the example of being the legally independent bank. European Central Bank is also having the case, but it has the price stability as a major mandate. US Federal Reserve has the both the interest rate plus the instrument independence, which is also the dual mandate. And in India, we already have the MPC in this regard. And if you try and understand that how the flexible inflation targeting and monetary policy committee rules matter for the commercial bank, because this course is all about the commercial banking. So we know that whenever we have high inflation, and if the anchor one, a nominal anchor variable, is not in the hand or control of the RBI, then we know that the rate of interest will shoot up, cost of borrowing will go up, and a lot of capital goods and high ticket lending may not be possible, because farms and the households will find it is very difficult, which means that repo rate and reverse repo, all these scenarios will change. Liquidity conditions, if you have a very expansionary monetary policy, you pump more money. But here you have to think in two ways. There are two counter argument here. One is called pro cyclical, another is called counter cyclical. What is pro cyclical and counter cyclical? So this is the business cycle, we say, right? So this is the peak, this is the trough, right? So this should come like this. Now we are seeing that this is the slowdown, this is the recovery, right? And this also. Now what we are seeing that in pro cyclical scenario, when the economy is at the peak, when it reaches the high growth, at that time they will be cutting the rate of interest, going for more expansionary monetary policy. But what will be the impact? This will impact in terms of, it may happen that because of this money supply increase during the peak of the business cycle, there will be bubble formation in the economy, and when it bursts, economy will again roll over on this particular line, which is sliding into slowdown. But countercyclical is when the economy is at the bottom or bottoming out, for example like this, right? Economy is at bottom or bottoming out, governments pump more money, central bank pumps more money, which means that cut down the rate of interest. When the economy is at the bottom, right, rate of interest is also going in terms of rate of interest is down. But when we have at the peak, when we reach at the peak, then we have rate of interest up. So here rate of interest is down, here also rate of interest is down, here we have a rate of interest up, and this plays very important role. In most of the scenarios, we find that it has a lot of important role to play, and it has the scenario of dealing with most of the conditions, and we find that pro-cyclical and counter-cyclical scenarios are important. So when we go for liquidity condition, if the government is going for counter-cyclical, then it means that when it is a peak, there will be less money, there will be control on the monetary policy. When it is the bottom, then they pump more money. We saw in last to last session, we had a unconventional monetary policy, long-term repo operations, targeted long-term repo operations, right? A special long-term repo operations, which means that there might be a money supply increase for some special activities, maybe MSMEs, NBFCs, right? So we saw all those kind of thing. Inflation expectations, when people see that the rate of inflation is higher and in next period also it is going to be higher, then it may further create trouble for the inflationary expectation scenario. So this is very important. Then third is the term structure of the interest rate, which means that when we have, for example, we saw in terms of operation twist that how central bank does with the long term and short term. So here it is also linked with the term structure, which means that if the rate of interest is high, the bond price will shoot up, but your yield will be lower, right? So this is where we often find. With FIT and MPC, these variables become more predictable and rule-based, and it is easier to have less asymmetric information, less of adverse selection, moral hazard kind of situation, and then you can also see that there will be proper communication. So predictability improves when we have such type of scenarios, right? So this is where it is very, very important. If you think in terms of how the commercial banks are again linked with them, so there will be asset liability management, right? So if you have a clear guidelines, explicit targets, then it helps in building up a more predictable inflation rates. Then there will be the asset liability management horizons. For example, the with the favorable interest rate scenario, on the asset side the bank is doing well, but on deposit side, because rate of interest is low, so people are not depositing that much money with the bank. So in that case, bank will compensate through more of a asset earning. So this is what reduces duration mismatch risk for the bank, because if you have a clear cut guidelines, proper explicit target, then we know that given the loan, suppose bank gives a real estate loan to a person for 20 years, right? And they have a cash flow already that for 20 years how much they are going to earn money. With the given inflation target, they can easily visualize that what will be the stand of the RBI in future, and based on that they will be taking measures. Funding and capital planning. Stable inflation lowers uncertainty in funding costs, supports better capital budgeting and credit expansion. So this is how here we have risk pricing and market discipline. So this is what we get: clear pricing signals, clear policy signals improve pricing of credit and market risk. So this is also important, right? So overall, what appears that the central bank, whenever central bank is taking a call on anchor inflation, and if anchor inflation is explicitly designed, then it helps in asset liability management, funding and capital planning, that what should be the rate of interest. Even the companies are going for investment through their capex expenditure, and if they know that this is the inflation target and this is what the RBI is planning with the current rate of interest, then they will have some expectation, and based on that they can decide on their NPV IRR, right? So what will be their earnings on their investment and how much they can think about, with variations of 1 to 2%. So but scenario analysis becomes important in that case, right? So it is as important as we often find. Now, besides this, there will be also a role of the nominal anchor and other on the external commercial borrowing. If they find that the borrowing in India, for example, if the commercial banks are going to charge very high interest rate, and if the exchange rate is under control, which happened during mid 2000 when we saw a big investment. At that time, majority of the companies, they listed outside, they borrowed money from external market because the exchange rate was favorable, 48 rupees per dollar at that time we had. So they borrowed huge amount of money to make investment, and they invested also, got good return. But then 2008 global financial crisis came, rupee started depreciating, and this created a whole lot of trouble for the government for these firms, and these firms started having impact on their balance sheet, because if the rupee is depreciating and if you have borrowed money in dollar terms, then you will have to have more dollar, and then they found it much costlier because the cost of borrowing went up and they were not doing well in the economy, so then they had to bear the cost. So this created a whole lot of trouble for the banking sector and others, which we saw in the twin balance sheet crisis. Then here we have the flexible inflation targeting and monetary policy, which is also related with the macro volatility, that if we don't have a explicit target, then we might be thinking that what will happen to the inflation and other important variables of high frequency like index of industrial production, which is a monthly nature. Then you can also think about the exchange rate basket, real effective exchange rate and nominal effective exchange rate. So export, import, all those variables are having a lot of say, and especially the investment part, which is highly sensitive. So if investment comes down, then we know that IS will left, and this will have the impact on the aggregate output. So this is where it is very, very important, right? So with this background, I hope it has helped you understand what is it. Now we will be moving to a new topic, which is called the Taylor rule. This is also called as the monetary policy rule. Why it is called monetary policy rule? Because here we have a nominal interest rate, which is IT. You can see here it is R star plus pi t plus theta pi. So here we have, you can see your nominal interest rate IT, it is equal to R star pi t theta pi t minus pi star and theta y t. So what is that? IT is equal to nominal policy interest rate, which is the repo rate in our case. R star is a neutral, natural real interest rate. What is neutral? In the sense that the rate at which you don't have any unemployment, right? So this is at this the economy clears, right? Which means that, so you can think about, if your pi t in this equation, you can see if pi t is equal to pi star, right? Then we know that this is going to be 0, right? And if you don't have any output gap, right? So here yt, that here you have yt is nothing but yt minus yt star, which means that this is nothing but, you can say, this you can easily say here. We can come back. So we can see here, yeah. So here we have a yt. So yt that we are seeing, it is nothing but it is called output gap, right? What is this output gap? So output gap is nothing but, here we have yt star. So this is the actual output, and this here we have the potential output. What is difference between actual and potential output? Actual output, if we have a, let's focus on first output gap. So if you have yt greater than yt star, it means that this we call it as the overheating scenario. Overheating in the economy, which means that your aggregate demand is greater than aggregate supply. So in that case, you have more demand for goods. So which means that this scenario is considered good and favorable for the economy, because then economies will then the firms and all the investment activities will be taking place. There will be slightly moderate inflation in the economy, and this will incentivize further the businesses to invest. And YT is the potential, which means that given the machinery and tools that we have, right, how much we can produce the output. So this is what here we have. And then actual output means how much we can actually produce in the economy, right? So this is what we get. So here we have yt is greater than yt bar, which means that if your actual output is greater than the potential output, means that you need more output than what you can produce. So it means that you will be either trying to catch up, so more job activities, more employment creation, and this has important effect on the Phillips curve. We have one relationship in Phillips curve that shows that if you have a inverse relationship between that shows inflation and output unemployment. So Phillips curve is basically showing inverse relationship between inflation and unemployment. So you can think about, in this scenario, If YT is greater than YT star, there will be more catching up process, more investment, more capex, more government expenditure increase. As a result, you will have more employment created and your Phillips curve shift leftward. But opposite of this will be, we have a YT is less than YT star. Then in this case, we have oversupply. And what it means? It means that once I have the oversupply scenario, then we are so everywhere you'll find 50% discount, buy one get one, which means that companies have more inventory, they want to first clear. So in that scenario, if you calculate this with filtering method, Hodrick Prescott filter, you apply on nominal GDP data, and then you will be able to get this output gap. So oversupply scenarios are more troublesome, because then in this case Phillips curve shift rightward, which shows a inverse relationship between inflation and output, right? So this is what here we have pi and u. So this is what Phillips curve shows, right? So PC1 and PC2. If you have a this scenario, then this leads to shift rightward of the PC. If you have a this scenario, right, then this will shift inward, right, and this creates a more employment in the economy. As a result, it shifts leftward. Now here, one of the good things about the output gap is that it is able to help you understand the overall functioning of the economy with this simple set of YT minus Y bar. How do you calculate? Suppose you have a GDP data. So any data will have trend and cyclical component. So trend and cyclical. If I do a filtering method, every data will have trend, right? So GDP, if you plot, this goes like this. So I can draw a line like this trend. So if I do a filtering method, apply a filtering method, which we normally call it as HP filter, we apply, you can calculate the trend. Once I have trend calculated, I need C. So which means that if I go for GDP minus T, I will get this C, and C is the cyclical. It can be positive, it can be negative. In some periods it will go up. So and this C becomes your output gap, which is basically a cyclical component, right? So output gap. Similarly, you can also calculate the inflation gap, but in this case the trend is given already, the inflation target that here you have. Now here you can see, if your current inflation is equal to this, then this becomes 0. If your output gap is also same, YT is equal to YT bar, then this also becomes 0. So which means that what do you get is nothing but your IT is equal to R star plus pi t, right? So this is what we get. Now here we can say that this, so this R star, if you just see, is nothing but your IT minus pi t, right? So nominal interest rate minus the inflation rate. So which means that it becomes like a real interest rate, right? So in most of the scenarios, we are able to find that real interest rate is what we, so the neutral or natural real interest rate is the rate at which we are able to clear the output gap and also the inflation deviation. And this is what we say, what I told previously, that why real interest rate central bank credibility matters, because real interest rate has to be positive. So this is what we call it, a neutral natural real interest rate. It has to be positive, otherwise it will create a bad impression. Suppose here also we find that 4 minus 4 is equal to 0. So your R star is equal to 0. No one would like to keep money in the bank because they are not hedging inflation, right? So your inflation is suppose 5% and your nominal interest rate is also 5%, you have a 0, right? 0%, which means that people are not able to hedge the inflation, and this will create a negative impact on the economy. So with this, I think I will stop here, and then we'll continue in the next session, and we'll try to cover some more dimensions. I hope you are liking this particular course, and if you have any question, you can always email to me. I'm happy to answer. I appreciate your attention. Thank you. Thank you so much.